The dollar's looming crisis. The US dollar has dominated global trade for 80 years, but history shows reserve currencies rarely last forever. Britain's pound sterling, once the backbone of global finance, lost its reserve status in the 1940s, triggering decades of instability in their bond markets. The dollar now faces a similar trajectory. At our current pace of debt growth, its privileged status could erode within 20 years. This isn't speculation, it's a mathematical inevitability. Central banks have been quietly preparing for a post-dollar world. Gold purchases hit record highs in 2022 and 2023, with countries like China and Poland stockpiling reserves. Russia now backs its ruble with gold after being frozen out of dollar markets. Even traditionally pro-dollar nations like India are settling more trade in local currencies. The BRICS bloc has launched a gold-backed trading currency to bypass the dollar entirely. These moves are like cracks forming in a once unshakable pillar of global finance. Congress is aware of the threat. Lawmakers have held hearings on creating a digital dollar to compete with China's digital yuan. The Fed's research shows 130 countries are exploring central bank digital currencies. Why does this matter? Because whoever controls the digital payment infrastructure controls the future of global finance. Falling behind here could accelerate the dollar's decline. The numbers paint a stark picture. The dollar's share of global reserves has dropped from 71% in 2000 to 58% today. While that might not sound dramatic, the pace is quickening. In the past 2 years alone, the decline matched the previous decade's total. If this trend continues, the dollar could lose its majority status by 2030, a point from which no reserve currency has ever recovered. Foreign Treasury holdings reveal the shift. China has slashed its U.S. debt holdings by 40% from their peak, and Japan, our largest creditor, has also reduced exposure. Even Belgium, often a proxy for Chinese transactions, shows declining Treasury positions. These aren't temporary adjustments. They're structural changes in how nations store wealth, with significant geopolitical consequences. A weaker dollar means less leverage for the U.S. on the global stage. Commodity markets provide another warning sign. Saudi Arabia now accepts yuan for oil, breaking a 50-year tradition of dollar-only deals. India pays Russia in dirhams for energy, and Brazil and China trade in their own currencies. Since oil and commodities underpin global trade, these deals chip away at dollar supremacy one transaction at a time. The bond market implications are severe. When Britain lost reserve status, their government bond yields became more volatile and higher overall, as investors demanded extra compensation for holding sterling-denominated debt. A similar fate could await U.S. Treasuries if the dollar weakens, with ripple effects across the entire economy. Trade patterns amplify the risk. The U.S. share of global GDP has shrunk from 40% in 1960 to 24% today. As economic power shifts, so does currency usage. The euro already accounts for 20% of global reserves, and Asia's rapid growth could further erode the dollar's dominance. Political dysfunction adds to the uncertainty. Debt ceiling standoffs and government shutdowns make dollar assets seem riskier. Each crisis chips away at confidence in the dollar's stability, further weakening its foundation as the world's reserve currency.